Right, and moving on, RBI has come out with a circular on the transactions involving AIFs. Regulated entities have been advised not to invest in AIFs with downstream investments in debtor company, and if they are already invested, they need to liquidate the same within 30 days period. My colleague Ankur Mishra is joining in live with more details on that. Take it away, Ankur.
Yes, Reserve Bank of India has come out with clear guidelines on some of the cases where evergreening of loan was found, and now regulator has said that regulated entities cannot make any investment in AIFs where downstream investment directly or indirectly is there in a debtor company. This means that there should not be any loan exposure to the company where you are buying those subordinate investments in AIF through that route, and therefore the evergreening of loan is kind of being stopped by Reserve Bank of India. Apart from that, there is also one of the regulations which says that if there is already an investment which is there by a regulated entity in any of the AIFs, that should be liquidated within 30 days. But what happens if that liquidation doesn't happen in the stipulated time period? There needs to be 100% provisioning done by the regulated entity of Reserve Bank of India if that norm has not been adhered to. Apart from that, there is also a direction that any investment by regulated entity in the subordinate AIFs, now that needs to be by priority distribution model, and that should be subject to full deduction of RE's capital fund. So that kind of cap is also there from the regulator. All in all, these steps has been taken by Reserve Bank of India after SEBI had highlighted few concerns to Reserve Bank of AIF evergreening, and ever since these kind of cases were brought to notice of the regulator, there are now new regulations so that these regulatory gaps can be filled and evergreening of loans can be stopped.
Thank you so much for joining us today.